Hope everyone is doing well. It's been a few weeks. Okay. Actually, yeah, it's been a few weeks since we did anything here, but we had a great time at the conference in Barcelona. Really, that was the first time I actually did that with FX Street, and it was really neat. Better than most conferences you go to because we actually spent most of the time doing trading and actually really diving into the markets for extended periods of time as groups. It's pretty neat. I have a feeling that that's not going to be an easy secret to keep, and that other conferences are going to start doing that. But so really good stuff there. And what I was reason I brought that up as well is because today I thought we'd go over a good chunk of what I covered at the ITC. All right, everybody on board with that? And if you have any questions, comments along the way, go ahead and type them in there. I'll try to get to them, and then you have my email as well. Okay. All right. Yeah. So again, I'll give you the 2 minute version of my path. Okay. Um, as some of you may have heard me say before, I started on the floor of the Chicago Mercantile Exchange, handling institutional order flow from banks, institutions, funds, big groups like that. Okay, and when you have those real buy orders and sell orders in front of you, can you lose money as a trader? If you're the guy holding the orders, if you see where the banks are buying and where the banks are selling, can you lose money as a trader if you have those orders in front of you? It's if the pound is trading at 160 and you see that the bank has a ton to buy at 159.40, where are you going to buy? Where's the astute market player going to buy? Where's the consistently profitable market player going to buy? Same place, right? In fact, until all of that bank demand is filled, is it possible for price to go lower than that level? No. And no, right. Okay. And so having that as my initial experience with trading in markets was pretty powerful. Okay. Of course, well, let's continue on. Pretty powerful, and of course seemed very easy. You could ask me any day where prices were going to turn. Of course, I could tell you. It's not because I had any crystal ball or because I was any math wizard or anything. I simply knew where the orders were, right? Like anybody who handles orders. Well, what about now? I'm not on a trading floor anymore. I sit in front of the screens just like you do. Can we still see those orders? Can we still see where the bank is buying and where the institutions are buying and selling? Most people would say you lose that edge after you leave a trading floor. I would strongly argue that you don't. In fact, I would argue that you see it just as well, if not better, through the screens. Okay? The key is to know what you're looking for and know what that consistently profitable market player demand and supply looks like. Okay? Yeah, PA, that's a great question you're asking there. Is there a way to anticipate exhaustion of orders prior to price actually moving, and who's actually seeing the stack? That's a great question there. He wrote in red, and that's one of the things what you're asking there is a breakout, okay? And we are going to spend a good amount of time on that today, okay? Timing the entries is everything. If you can time your entry properly, then you're able to trade low risk and high reward. If you can't, I wouldn't even suggest trading, okay? Because all you're going to do, if you don't know how to do it, what's going to happen? Your account is going to get transferred into the account of somebody who does. Does that make sense to everybody? Zag's asking a question here, why is it not picking tops and bottoms? We absolutely want to pick tops and bottoms when it's according to our rules, okay? That's the key, all right? So the ability to see where that supply and demand is, and then knowing and understanding who is on the other side of your trade. Let me explain that just for a minute. Okay. Again, being on the floor, let's say there were a lot of orders to sell in the pound at 161.50. Okay, and let's say prices were much lower than that. Well, throughout the day, prices would come up to that 161.50. They'd rally up there. Okay, and yeah, we're going to go over a lot of that stuff here today. So prices would slowly rally up to that level at 161.50. And as prices got close to that level, the phones would start ringing, okay? And there was a group of traders that was looking to buy at or near all that supply at 161.50. Who do you think it was? Okay, who do you think it was? Do you think it was the institutional lines, or do you think it was the retail lines? All right, who was coming in and buying right near all that institutional supply? Okay. Yeah, the retail group, okay? In fact, you could almost time exactly when that phone was going to ring based on price. All right? So, over and over in my early days, I saw that this whole game was just retail accounts being transferred into institutional accounts. Another way to say that is the consistent losing trader account being transferred into the consistently profitable trader's accounts. What that looks like on a chart is very, very easy to see, and that's a big part of what we're going to go over today. Okay. What I spend my time doing now is primarily two things as far as our work goes. My career is spent trading, and I also run the live Forex trading room at Online Trading Academy. Okay, and so the things we'll talk about today, we implement those things during the week in the trading room at Online Trading Academy. All right, let's move on. Okay, not gonna spend more than about 10 seconds here. I've already said this. You need to understand who's on the other side of your trade, and we need to look at objective information analysis to tell us, right? Is it a consistently profitable trader? Is it a consistent losing trader? Okay. Consistent profits begin with a solid understanding of how markets really work and what is going on behind the scenes in your charts. In other words, if you're someone that still just looks at red and green candles on a chart and makes decisions based on conventional technical analysis, you might do okay, but your chances are you're not going to do as well as the trader who's able to see through those candles and understand the order flow that's behind the scenes that's responsible for the creation of those candles. Does everybody get that? That's something in the program I do during week one. That's something I really make sure that's a goal. It's a monthly program, and it's a goal of mine to make sure that people can do that. Right? It's all about gaining the edge. So here, understand that anytime prices move in a market, it's simply a function of the ongoing supply and demand imbalance. All right? Let's just keep it simple. Why? Everybody see this cluster of trading right here? Everybody see my mouse moving around? And then this one down in here. Can everyone see my pointer? Great. Right? Notice how prices are trading sideways down here. Okay? In other words, all the candle bodies are kind of next to each other, creating a zone. Right? It appears that demand and supply are imbalanced down here. Okay? But the truth is, behind the scenes, it's never balanced. It's always out of balance. It just takes a certain period of time for that unbalanced equation to play out. When prices rally out of this level, this rally out of this level tells us that there are actually more buyers than sellers here. Okay? All right? When price revisits that level, who is selling here? Well, someone is selling after a drop in price and right into a price level where demand exceeds supply. Right? Is the seller down here a consistently profitable trader or a consistent losing trader? Are they just your average retail trader or someone that knows what they're doing. Does everybody get what I'm saying there? Okay. There's a question here. Could you explain the difference between pivots and clusters in order to quantify demand and supply? Absolutely. And let me do that in the form of a question so you guys really get it. Okay. Now, before I ask the question, remember we're talking about supply and demand, buyers, sellers, right? At price levels where supply and demand are most out of balance, that's the best opportunity, correct? Would everybody agree with that? We want to find price levels where supply and demand is really out of balance in a big way, right? Yeah, okay, good. So you agree with that. Well, now let's transfer that onto a chart, okay? At price levels where supply and demand is really out of balance in a big way, does price spend a lot of time at that level or a little time at that level? Okay, and with this, we're taking things deeper than we usually do, the information. Right. At price levels where you have your biggest supply and demand imbalance, price spends the least amount of time, right? Okay. Therefore, what would be the picture of a stronger supply-demand imbalance? A cluster of trade candles or a pivot? Yeah, exactly, a pivot. Okay. There's a reason why that pivot is there. It's because the number of buyers and sellers at that pivot point, it's so out of balance, and that's where the opportunity is. Okay. So let's keep moving on here. Right. So here's an example that's more of a kind of looks more like a pivot, right? And this is really what's happening behind the scenes. Okay. Prices come down. This is kind of a pivot low, couple candles here. But behind the scenes, you've got a very unbalanced equation. You have a lot more willing buyers than sellers, okay? But it takes a certain period of time for these transactions to take place. But once the last seller sells at this price level and you have any buyers left, price is going to scream away from that area. So this pivot low here becomes a demand level that we'd want to remember. Because when price revisits this level, who is selling here? Well, the seller who's selling here is making the same two mistakes that every consistent losing trader makes. They're selling after a period of selling, mistake number one, and they're selling at a price level where we've already determined that demand exceeds supply. Okay? And the big thing for you to understand is, number one, understanding that, but number two, whose supply and demand is it? Does the retail trader have the account size to move price like that? Or is it a bank or institution, right? Someone who's handling major order flow. So when people say, you hear it all the time in Forex, well, we can't see volume and we don't know where the banks have their orders. I don't buy that at all, right? The price action tells you everything you need to know. In fact, anything you're going to add to that is likely to keep you out of your best trading opportunities. Does everybody understand that? Think about this. Let me bring up something that's pretty popular in the trading books, right? Every time you see a major kind of high or low in a market, what does everybody want to look for with regard to volume, right? For putting in like a major high or a major low, what is everyone looking for? What do all the books tell you that you have to have with respect to volume? Big spike in volume, PA suggesting, right? Above average volume, things like that, right? High volume, yeah. Okay, but now think about it. Don't just take my word for it. Think it through. At your price levels that produce your biggest turns, which is where supply and demand is most out of balance, is there ever big volume? Do you have a lot of volume? In other words, are a lot of transactions able to take place? No, right, exactly, not at all. Okay, so it's completely backwards. But every conventional technical analysis book out there, tells you have to have that, and that's not such a bad thing because we need, when you're a consistently profitable trader, you're going to love the fact that that a lot of the books have a lot of this stuff wrong. Okay? So what we do is when we see prices move, the first thing you want to do is look for price levels on a chart where prices could not stay at that level. Okay? Find price levels where prices really screamed away from an area and then wrap a couple lines around it. Okay? And look to buy the first pullback to that area for demand and look to sell the first rally into one that is supply. All right, let's keep moving on here. Okay? And again, this is the process here. All right? It all starts with the origin of the move in price here. Prices scream higher from this level. Okay? When prices come back into this area, simply ask yourself, who's buying and selling here? When you focus on the seller, you'll see that they are selling after a decline in price, which is not smart to do, and they're selling at a price level where the chart is already telling you back here that demand exceeds supply. Okay? A consistently profitable trader would never sell here. How do we know for sure? Because they wouldn't be consistently profitable. The laws of supply and demand guarantee that. Okay? They're simply handing their account over to somebody else. Okay? All right. Let's keep plugging away here. Again, just an example, right? On a bigger time frame, this is just a pivot low, but prices drop. For demand, you always want to see a drop first. Prices trade here, and then they shoot up. And what you want to do is really ask yourself, why does price shoot up from this area? Okay? Well, it shoots up because it has to. It can't stay here because there's too many buyers here. Therefore, if and when price revisits this level, and like someone is suggesting I'm going to go for the first time, which is a very high probability, you know that you've got a novice seller selling. Someone is selling after a drop in price and right into a price level where demand exceeds supply. Okay? We simply want to be there to take the other side of that trade. Yeah, Joe, exactly. Now, let me ask you this. This all may seem easy, and the logic I know is pretty simple. The rules are very simple, I can tell you that. But what makes it so difficult? Okay? What makes it so difficult is actually doing it. Right? When we were at the ITC, we hit some really good trades there. But setting them up, we set them up together, and it seemed like people got the hang of it pretty quickly. But the interesting part was when it came time to actually take the trade, probably not even half the people that had the trade planned even took it. Okay, because this will challenge every emotional bone in your body. Okay, let me move on and show you. Let's give you an example on the sell side, okay? Yeah, human emotion really knocks most people out of the world of trading. So have a look here. Can everybody see the chart I have up here of the pound? Everybody see this one? Just to make sure everything's still working here. Notice the origin of the drop in price here. Okay? Big, strong drop in price, suggesting a big imbalance of buyers to sellers here, right? Here, prices come back up to this area. Our rules would have us selling short here with our buy stop on the other side of this area. Now, why is it so difficult if you have this trade planned out? Well, look at this rally into the level. What do you think the news is when prices are moving up like that? You think it's good news or bad news? Yeah, it's good news. Exactly. And do you think the moving averages and all the indicators, are they pointing up or down during that rally? Yeah, they're absolutely pointing up. Okay. The green candles, all those things. You have so many things coming at you during this rally that really just make the urge to buy so strong. Okay. And that's why most people up here, especially the retail world, are going to be buying. Okay? But again, if you sit back at this point, the way to get over the emotion, one of the ways, there's a couple ways, one of the ways is, to sit back when prices get up here. When your rules say enter and you're scared to push the button, okay, just sit back and say, wait a second, I know everybody's buying this market. I know the news is great. All these green candles, everybody in the world, some expert is on television now telling me to buy. But just ask yourself this one question. What would a smart buyer and seller of anything do here? That's the question you have to ask. And when you come at it from that perspective, the answer is very clear. Okay? When you see that you have someone buying, aggressively buying after such a giant move up in price, and right into a price level where the chart is screaming at you that supply greatly exceeds demand, there's only one thing to do, right? Sell short. Okay? And is every trade going to work? No, of course not. Okay? But every trade is not going to work, but that's why, given the fact that every trade doesn't work, given the fact that there's never 100% certainty in trading, your desire, your goal should always be for low risk entries. Okay? Most people don't come to grips with the fact that there is no certainty in trading, and they're not comfortable with losses. Okay? I actually, just a quick little story that happened recently. There was a trading student that, boy, his levels were fantastic. I mean, he would send emails way before prices would get to his levels, and he was right most of the time. And he could pick turning points with the best of them, but not every trade works. That's why we always, just so you know, when it comes to profit taking or profit margins, just because you have a level, you need a profit margin. And we're always looking for at least 3-to-1 to the first target. Given that, if he would just take every trade, he'd be fine. 2 losers in a row with those numbers, well, you'd need 2 winners in a row, you'd need 6 losers just to bring you back to break even if you're sticking to your rules. So, and most of his trades were winners, but he really had trouble with the losses. He couldn't stand taking a loss. It was like an emotional train wreck when he took a loss. So, what I suggested to him, I kind of got an idea of how much money he had in his account and stuff, and not that. Well, anyway, just what I did was I just said, okay. I said, can you part with $100? I was really helping him out, and I said, look, can you part with $100? And I think at first he thought I was asking him for $100 to help him, his payment. That's not at all what I was doing. But I think that's what he thought at first. He's like, yeah, of course, sure, absolutely. And then I said, well, no, it's not for me. I said, but can you part with $100? It's like, yeah. I said, all right, let's pull up the charts and let's just start taking some trades, but let's make sure you lose. Let's go take a bunch of small losses, okay? Let's take a few small losses in some minis, and just take a bunch of losses till it totals about $100, okay? Let's take small losses so you get the handle. We weren't trying to make money. In fact, we were trying to lose, because I just wanted him to see that it's just no big deal. If you're applying proper risk management, the losses are nothing, okay? But that's why we focus on the risk so much, okay? Yeah, so Joe's typing in there. Yeah, take some small losses. I mean, you're going to have losses anyway in your career. Instead of giving big losses to the market because you don't take care of the problem, if it's a big deal, just go take some small losses, and it's no big deal. You'll get used to it. Anyway, let's move on. Sorry, I got a little sidetracked there, but I thought it was an important story. Okay. Yeah, we'll talk a little bit about trends, Hanson, in just a bit. Actually, I can mention it now. Obviously, if you're in an uptrend, we want to buy pullbacks to demand. If you're in a downtrend, we want to sell rallies to supply. But we'll take it further than that. ZBYS, why doesn't the increase in buying a resistance push price through it? Because it's the drop in price to the left that shows you that there's so many sellers. There's a lot more sellers, okay? And because price had to rally all the way up to that level, you've used up a lot of the buying power just getting to that level. So you actually reach that supply level with, at the end, very few buyers. And, of course, novice buyers, okay? Yeah, we actually have a very specific way that we enter these. I'll try to get to that today. Okay. All right, let's move on here. So make sure that even though you might have some nice levels here, okay, make sure even if you have a great level or two, it doesn't mean you have a trade. There has to be a profit margin there. In the live trading room that I do at Online Trading Academy, it's called XLT, Extended Learning Track. During week 1, we go over the odds enhancers. There's a list of 5 of them, and if we have a scoring system, if we have all 5, then we feel like we have a great trade on our hands. And one of them is to make sure that we have a significant profit margin to the first target. Okay, for me, it's at least 3 to 1, and that's just to the first target. Meaning, if this is where you're going to buy, and you're going to put your stop down here, make sure your target is at least your first target is at least 3 times this distance, right? So if you're risking 1% here, make sure this is, you're making 3% to the first target. Okay. Just very quickly here, for people who, one second, let me just read back. Yeah, Bo's asking a good question there. There's 2 ways we enter these. For those of us that use the scoring system, if we have a very high probability entry, typically I'm going to use a limit order. I mean, I most of the time I'm going to use a limit order. But if you're new to this, okay, what you want to do is to be safe on the safe side, let prices come into your area, and then look to jump in the trade as they're leaving the area very quickly. You may not get the best entry, but at least you're getting it's a very safe way of doing it. In other words, let prices come into level. If it's a demand level, let them come down into your demand zone, then buy as they leave the demand zone, and make sure you put your protective sell stop just below the level. Does that make sense? Okay, so take a look at this chart here. For those that really like the indicators and oscillators, that's great. That's fine. But if you use them the way the textbooks tell you, what's going to happen to your accounts? If you use the indicators and oscillators, as is, the way the textbooks tell you to use them, okay, you're probably going to be in trouble, right? Okay, and then if you try to, if you take conventional, technical analysis, the way it looks at indicators and oscillators, and start crunching the numbers, again, that leads to losses. Instead, wrap the same logical rules we're talking about here to the indicators and oscillators. When we use a combination of a moving average for trend and an oscillator for your entry signal, it would go like this, okay? And these could be very, very hard and set rules. Whoops. When the moving average is sloping down, or we're in a downtrend, the only thing we want to do is sell, okay? Who do we want to sell to? Again, who is on the other side of your trade, right? That question. Who do we want to sell to? Well, we want to sell to someone who's aggressively buying after a period of buying in the context of a downtrend, okay? Someone that buys after a period of buying in the context of a downtrend can't make money. They might have a winning trade here and there, but over time they're going to lose. The odds are stacked against them. So we use a combination of the moving average and the oscillator. So here's the rule. In a downtrend, okay, which means a downsloping moving average, a clearly downsloping moving average, we want to take every overbought reading that the oscillator produces as a sell signal. Okay? Here, stochastics crossing an overbought territory in the context of a downtrend on the chart means that someone is making a big mistake. Okay? They're buying after a period of buying in the context of a downtrend. Right? The oscillator, gives us that trigger, that entry trigger. We also have to, in a downtrend, very mechanically ignore any oversold reading that comes up. Okay? Right? So here, stochastics comes down and crosses down here. We do not want to take that. Okay? We don't want to buy in downtrends. So in a downtrend, sell overbought, ignore oversold. In an uptrend, buy oversold, ignore overbought. Okay. All right. Here's a trade that came up. Um, I write a weekly letter for Online Trading Academy, and does anybody read it in here? If you don't, you could just go to the Online Trading Academy homepage. You'll get it every week. It's the free articles and down in the right. Some people in here might get it, but anyway, on May 30th, I just cut and paste this right out of the letter. Suggested selling the pound when it was around 2-to-1 to the dollar because of a very specific smaller time frame setup that you just don't see on this chart. Okay, and anyway, anybody that's in the I know there's one or two in the XLT here. From that point, we've hit every bigger picture move in the pound up until right now. We've taken the pound from 2 to down to 175. We bought the 175 up to 185, then shorted down to 159, and just recently in the live trading room, I can show you here. We actually bought the pound at 146.20. And those prices and everything are, we record every session, so we have all those. Oops, let me blow this up for you. Okay. Can everybody see my screen here? Just want to make sure everybody could see TradeStation now. We're looking at the pound. All right, great. So, yeah, just recently, this is a bigger picture time frame, but in the room, we're long from 146.20, looking for a move up to 154, 155. Okay, and again, while these trades are very predictable, and we actually plan them out days, if not sometimes weeks in advance, again, actually taking them will challenge every bone in your body. All right, and we don't just take swing trades, and we day trade, swing trade, position trade. But the point is, you have to be in before others. If you're waiting for, right? Does everybody see the chart now? See the big difference? See how it's just a big giant red candle down to support? Okay? Most people are not comfortable buying there. If I wouldn't be following rules, I wouldn't be comfortable buying there. Because if you're watching TV, all the news is bad. All the indicators and oscillators are really bad. You know, everything's pointing to more downside. Okay? But when you sit back and say, wait a second, whoever is selling now is selling at a price level where demand exceeds supply, right? And they're selling after a giant drop in price, there's only one thing to do. The low-risk position to take is to buy. Now, let me bring something else up for you. Okay? I want to share something with you here. Okay? Yeah, Jill, there was some demand from the left, back to the left. Okay. Now let's switch gears here a little bit. This is from an article I did a little while back, but there's two ways that you can trade, you know, these demand and supply levels to and from each other. You could take the reversals, or you could take the breakouts. In the Forex markets that move so fast and so far, these are the best markets out there to take breakouts. But again, if you're not handling your breakouts the right way, you could be in big trouble. Okay? So when do we want to take a breakout? Do we want to take it as price is leaving the level? Well, you have to be careful with that. Often it's a better idea to get in right before they break out. Well, how do you know that's going to happen if you don't have a crystal ball and you're not looking at the orders in front of you? Well, again, focus on the price action. Don't just focus on red and green candles. Okay? Let's talk through this chart here. So everybody can see this little chart I have here. Just want to make sure the screen is changing as I'm changing it. Okay. So each time prices hit a predetermined level. Now to the left here, there's probably, there's some resistance. Each time price hits this black line, which is the supply level, how do we know it's supply? Because prices can't stay there. They keep falling from that level. But understand that each time price hits that level, it falls away because it has to, because there's too many sellers there, too much supply. Okay? But each time it hits that level, what's happening to the number of willing sellers there? The amount of supply, is it increasing or decreasing? Okay, it's decreasing because every time you hit this level, some of the sellers that are sitting there that want to sell are able to sell. Therefore, you're removing the sellers. Okay, you're chipping away at the wall there. Okay, and but now again, think of how the textbooks tell you to do it. Nobody says buy or sell the first time prices come back to a level. The books say, let an area be tested a couple times. Make sure there's buyers or sellers there. Then take the trade. Well, what does that really mean? What are they really saying? Okay, what they're really saying is, don't take the low risk, high probability trade. Let that level be hit a few times and take the low probability, high risk trade. Does everybody get that? Okay. So don't just believe what you hear and what you read, right? Just think it through for yourself. Well, here's the thing, Jill. Okay, and we actually spent a lot of time working on the double top. But again, we don't enter the double top the same way everybody else does. We look to be a part of that second top. Okay. All right. So here's the thing, and here's the key to that. All right. Notice that each time you hit this level, the declines from the level are more shallow, right? Each decline is shallower than the prior drop. Okay, prices are falling away. They're not falling as far, and they're not falling as fast. Okay, eventually you're going to come to that level, and you're not going to fall anymore, but you're actually going to start basing at that level. And that's the key to the textbook breakout. When you see basing at a level where, when you look to the left, price was just screaming away from there, guess what? It's not a level anymore. All the supply has been absorbed. Prices are about to move higher. Okay? That's the low-risk way of entering a breakout. It's also a way of determining, when a breakout is going to happen, obviously, before it happens. That's the key. All right. Here's a trade that was taken. Okay. Oops. Here's a trade. I just cut and paste this right out of my email. This is one of the people from the trading room, John Clark. He's from the UK. I don't know why this keeps switching back to. There we go. So you can see the chart on the left is a big time frame chart of the pound. Chart on the right is a smaller time frame. And as I said, we've really, the pound has just been an unbelievable market. We've been able to, every move has been so clear, and you can probably see it from here. So here's that move from, it was actually about 2 to 1 to the dollar. We caught this short in the letter from May 30th. This came down right into a predetermined demand level. Okay. This bounce here, this is on the big time frame chart. Here's what it looks like on the smaller daily chart. Okay. John Clark actually bought it in here and took it up to an area where there was some supply. Made about 400 pips on it. Okay, and then up in here, the 185.86, we were looking to take price back down to about 159. Obviously, it went lower than lower than 159, but okay. 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 PA, yeah. So why I get out at 154.55 instead of 195? Yeah, I mean, remember, everything we do is very rule based, and we've got our rules, and I'll bring something up for you in a minute that will help kind of with that answer. Okay, Tony, the reason why we're focused on reversal points is because we want our stop to be as close to our entry as possible. Okay, the key to this is low risk, high reward entries, and the only way to attain that is to be able to identify where prices are likely to turn with a high degree of accuracy. The only way to do that is look at the reality of what's happening. Don't let any subjectivity come into your analysis. Okay? Subjective emotional decisions for us equal opportunity. As you know, as I'm kind of pointing out here, trading is simply a transfer of accounts from those who don't know what they're doing, obviously into the accounts of those who do. And let me bring one more thing up here for you. Just one second. Okay, can everybody see the Word document I have up here? Everybody see that okay? Yeah, good. I keep switching. Here we go. The reason I'm bringing this up is so you can see, we always have about 45 minutes to an hour in here, and but this is the live trading room that I do. You can see it's a combination of lessons and then live trading and analysis, and it's a whole 1-month program that kind of repeats itself. Obviously, the live trading and analysis, the markets are always in different places, so that's never the same. The way we handle those markets is the same, but the lessons repeat themselves every month and are reinforced. So you could see, what I'm trying to do today in 45 minutes to an hour is give you important pieces of the puzzle, but it's difficult to give you everything in a short period of time. But during week 1, we cover the foundation, quantifying demand and supply, all the odds, enhancers, and rules. Week 2, we get deep into the exact entries and exits and trade management and begin to develop, make sure you get the strategy down. We then put that into a trading plan, and then you can see in week 4 we try to make sure that trading plan is solid, quizzes, and then a big test at the end. And that test is a pretty rigid test to make sure that you know what you're doing there. But in these sessions at FX Street, just like at the conference, try to give as much of the information as we can in that period of time. And because again, if you're, I can't stress enough how if you're ever interested in anything like that, you can always email me. There's my email address again. But the most important thing is to understand that this isn't that difficult. Why is it so difficult? It's because people rely on conventional technical analysis, which ignores many realities of markets. Okay, and when you come at it from that perspective, if you go to the bookstore and just buy the book that everybody else buys, what are you learning to do? You're learning to trade like everybody else, right? There's no edge there. Now, I hope most people end up doing that. That just helps. That just provides income for the people that know what they're doing. And I'm not trying to give you harsh words there. It's more of a, I'm trying to do you a favor, and just so you understand that trading is simply a transfer of accounts from those who don't know what they're doing into the accounts of those who do. And on that note, I know we're kind of out of time here. Okay. And if you have any questions about one thing you might want to do is, if you have any questions, you can always email me about that. You can also email charts or questions about things we went over here. We could take it. You can always keep going an email. I'm pretty good about that. I'm pretty open with most stuff. Okay. And yeah, add costs and stuff. I'd have to look into that because I don't really actually handle that part of it. But I know it's actually not that expensive at all. Am I in London? No, I actually just was in London. I just got back yesterday. So yeah, if you're interested in any more information on the things we went over today, and you have any questions, certainly email me. And we have another I'm not sure when the next session is that I'll be doing for FX Street. I know it's coming up shortly, I think in a week or something. But what we're going to do during that session is actually we're going to gear the whole session towards trading and analysis. Okay, and it's actually this Friday. Okay, we'll be doing some of that this Friday. We'll be going through the charts and doing this stuff, in the live charts. Okay. Again, we'll be able to cover most of what we do there. Of course, not everything, but most of it, and it should be a great day on Friday. Okay, so have a great day, everybody. Hopefully this was helpful, and be careful out there. Don't put any of your don't put any of your money at risk unless you have a solid edge. Okay, have a great day, everybody. Thanks.